Hey, good afternoon all, and welcome to our Fireside Chat. I think hopefully a lot of you will be accustomed to what happens on this call, but just to refresh, this is an opportunity to hear our analyst team's thoughts on various sectors and asset classes. We're quite pleased to have Chothia in with us today. When he isn't working on his golf handicap and caring for a newborn, he spends all of his time analyzing the listed retail sector. So this is obviously a very crucial sector for South Africa, one that's definitely had its downs over the past year or so as people's spending patterns changed, both as a result of supply side dynamics where shops are just closed, and also on the demand side where people's disposable income has been under pressure and consumers are struggling to really spend discretionary. And therefore, I think crucial that we understand the sector. So, Saad, thanks very much for joining us. How are you doing today?
Well, thanks to yourself, Avi. It's been a busy last few weeks, but yeah, I'm looking forward to the discussion.
Nice, thanks, Saad. So, I mean, let's get stuck into it, Saad. Tell us, set the scene for us. Tell us about the retail sector. What do we need to know?
Yeah, thanks, Avi. So from a consumer perspective, we all know where the consumer is at the moment. Most consumers are under pressure. We think that the constrained spending is going to be exacerbated over the sort of next 12 months. There's a lot of job losses still happening in the private sector. Unemployment is sitting at sort of 10-year highs. Nedbank is also forecasting consumption growth and household disposable income growth of around 2 to 3% over the next 3 years, which is very soft given historical standards. And I think consumer confidence, although it did show an uptick yesterday, we think it's still well below historical average as well, but it is improving. So overall, we don't think the pie is generally going to grow. We do think the listed South African retailers, given their agility, size, and financial health, will be able to take market share in the current environment. What we've seen, we've also started warming up to the sector from a listed perspective. We've actually got 6 out of our 8 companies in overweights at the moment, 2 are neutrals. And we think that strong cash flows, earnings growth, and organic changes in business models have been a key reason why investors have flocked back into the sector and some of these names in the last 2-3 months. If I just touch on one or two things, cash flows have improved. A lot of companies have cut dividends, cut back on inventory, lowered capex, and better rental negotiations have all started coming through. And for the food names, it's all been about shift in spending. So their sales have just surged, and a lot of this extra cash has been used to pay down debt, which has helped your earnings as well. That's why we've seen sort of a 15 to 20% re-rating in the share prices over the last sort of 3-4 months, and a lot of earnings beats and sales beats as well from recent results. If you look out forward, what we think will happen, we think your clothing retailers can easily generate 30 to 40% 3-year CAGR off the low basis of FY20, and in the food space about 7 to 10% as well. So I think it's all about a little bit of a sales recovery, a bit of debt repayment, a bit of cost cutting, and entering new categories and new strategies to grow.
Thanks very much, Saad. That really does set the scene quite well, and it's quite interesting that in such a weak economic environment, and our economist Rees always reminds us that it's going to be a slow recovery from here. I mean, you've turned a little bit more positive on the apparel sector in particular. Just give us your thinking behind the apparel sector in particular.
Yeah, thanks, Avi. So the reason why we've actually become a bit more sort of bullish, I think that, as I said earlier, a lot of South African retailers, they are very sort of strong. They've got scale. They've got power with landlords, with shareholders, funders, debt holders as well, and they've got cash on their balance sheets to actually invest in new strategies. So one is e-commerce, which is a very fast-growing sector as well. A lot of the companies are investing in there, entering new categories like the value segment through M&A, basics, smaller stores. And I think historically we've seen South African retailers move offshore, and there's not much synergies that one can extract from those moves. If you buy businesses locally, there's a lot more visible synergies like head office costs, IT costs, rental negotiations that can be extracted a lot faster and a lot meaningful for earnings. So I think, overall, we're going to see smaller businesses, more nimble, sort of better margins and better earnings growth coming through from these businesses over the next few years with better balance sheets as well.
Yeah, and I suppose the one thing that you highlighted there that, I mean, you've written a few notes on this in the past year or so, but this trend to value retail or the shift towards value retail, maybe just expand on that. What does it mean? Who benefits from this from a company's perspective?
Yeah, thanks, Avi. I think value is all about pricing points and what you get for your price at the end of the day, and how much you can for those rands, how much you can get for those rands. Historically, over the last few years, we've seen H&M, Cotton On sort of dominate that space, and you've had some local players, Mr. Price as well, in that space. But the local guys were getting ahead of themselves, maybe complacent in a certain way with no international competition. But then what happened was, the internationals came in and really gave them a run for their money. So what's happening now is that, consumers are getting more price conscious. They are trading down. Pick and Pay Clothing is another name that comes to mind in the value space. And a lot of the retailers, your mid-market retailers, have lost significant market share over the last sort of 10 years. I'd say 10 percentage points from about 60% to 50% market share. And it's all gone to value. So the likes of Pep have really benefited, Mr. Price have really benefited. And we think that those two names will continue, and Pick and Pay Clothing is the other one, and Foschini, with their acquisition of Jet, really dominating, will start to dominate in that space. And with their targets of opening up a few hundred more stores from the 400 that they've bought now with Jet, it's obviously going to put pressure on the other guys, and it's going to be a very good sort of competition to watch in that space over the next few years. We've also seen Truworths now starting to enter that space. So I think value is the flavor of the month at the moment, and I think it's probably going to be like this at least for a good few years. I don't see consumers trading back up anytime soon, unless you see disposable income really start rocketing, which is unlikely in the shorter term.
Well, I suppose that's a fundamental question of, if the economy does improve, and we think it does from here, and people have a little bit more money, whether they actually go back and shop up, or whether, value retailers are probably offering good enough quality at this point, and they stick around at these levels.
Yes, I think, what's also been happening globally is that promotion and more promotion is actually becoming a big thing, and customers are getting used to companies being on promotion. So they're always looking for the next deal, whichever retailer it is. And I don't think there's much customer loyalty anymore. Gone are the days where you just go to one retailer. I think you'll go wherever there's a good value, a good product, a good experience, and a good price. So I think even if disposable income improves, I think if customers get used to buying lower priced items, they'll keep doing that way and use that extra income for discretionary items, so homeware, electronics, traveling, those type of things. So at the end of the day, the fight for wallet is not just your competitors, it's other categories what consumers are spending on as well. So it's not just clothing, because I think people are just buying less clothing now, and it's all these other categories.
Yeah, that is a constant trend I think you see in recessionary environments where people's wallet is under increasing scrutiny, and it's tougher to get money out of that wallet. Saad, we also talked about consolidation previously. You mentioned Mr. Price a little bit earlier, and one of the guys that's really strong in the value space, but then they go and buy Yuppiechef, which is certainly not value. And I think there are a lot more transactions that you had highlighted. Just thinking around consolidation, maybe touch on what Mr. Price sees in Yuppiechef.
Yeah, I think from a consolidation perspective, a lot of South African companies, they do have strong balance sheets, and they have and a lot of the sort of local companies, unlisted companies, independents are struggling. Normally the independents are only selling one category, whereas the bigger retailers have, their earnings or sales are masked by cellular and homeware and those type of things. So yes, there's opportunities, and we're probably going to see more. There's a lot of unlisted players that are up for sale and who are willing to have a big brother to help them sort of negotiate with landlords, fund better sort of supplier arrangements as well. So I think that's on the cards, and as I said earlier, a lot of synergies for both parties as well. With Mr. Price, I mean, they're still, I think after their two acquisitions, the Power Fashions acquisition and Yappy Chef, still have about 5 billion on their balance sheet. So for them, they can go pick and choose any company. So Power Fashions really entrenches them in that really low-end value space from a clothing perspective. But the higher LSM market and consumers, obviously, they're still getting salaries, bonuses, those that have savings to dip into, are still spending money on homeware items, and especially when they've been at home. So I think from that perspective, the Yappy Chef acquisition should fit well in their business. And remember, it's easier to buy a pure play online retailer, which will help you advance at that part of your business, instead of building it out on your own, and when you might not have the full skills and experience in that part of the business and the online capabilities. So I think it's probably more of a complementary business to their current home business. And then it obviously gives you the access to these big international brands that Yappy Chef sells as well.
Yeah, that's a very good point you make there. So thanks. That this sort of is just almost a plug and play and doesn't require a massive effort on Mr. Price's part. So I think, I mean, if I have to sum it up, I think tough growth environment, but actually suits some players, particularly the bigger guys who can consolidate, and particularly the guys that are selling into the value space. And then Saj, you touched on online as well with that conversation. I mean, that's a constant sort of conversation that people have. Just talk us through the South African environment and what's your thinking around online retail.
Yeah, so online in South Africa, penetration has roughly been about 1 to 2%. I think it's probably moved up to about 5%, 4, 5, 6% right now. It's a lot higher in big cities and big nodes, and that's just the demographic difference there. I think it has been they always talk is when COVID, so when people vaccines are being rolled out, and if you go into next year, what happens to online? I think online is going to be a big part. I think there's a big structural shift from the retailers. They're really investing in their online capabilities, and I think TFG, I just had a chat with them. They're quite advanced with their RFID and stock systems and digital platforms and rolling that out. So I think online is definitely an area of growth that most retailers are going to invest in. They'd rather reduce capex in physical stores and invest in online capabilities on the logistics side, stock management, warehousing, and getting the whole experience for the customer right. I don't think anybody's perfected it yet, because online was not a big play for the physical retailers. It was just by the way to have it there, but now it's changed, and a lot of investment is going in there. I think it'll take maybe a few years till they're perfected, but it's definitely, you will see growth in that space, at least 50% to 100% growth over the next few years. So it is one to watch, and there will be fight for it, and it will be a definitely big growth area for all the retailers.
Thanks, Saad. And apologies, I'm going to put you on the spot. You did throw out a few figures there. So what sort of growth rates are you expecting for apparel retail, and maybe, I don't know how you split it out, whether it's value, online, or whatever the case is?
Yeah, so we're expecting sort of, from normal, your brick and mortar would probably range about, your value players, I'd say between 4 and 8% growth over the next 3 years. Your mid-market, between 0 and 1, 2%. And then online, probably see them growing. They have been growing 100% plus, and so I would think that it remains. It definitely will slow down, but it will remain definitely double digits. I would say between 20 and sort of 60% range as it slows down and as the base gets higher for most of the names. Yeah.
And then, Saad, if I just have to drill down one level more, just individual companies, which ones are offering the strongest growth rate?
Yeah, so if we look at on the value side, it's Pep and Mr. Price that are the winners in that space, followed by TFG, and then Woolies and Truworths are the ones around 2-3%, between 1 and 3%, I would say, for those over the next few years. Also note that there is a very low base effects coming through from this much onwards. So the numbers are going to be a lot higher. So that's something to note, but things will normalize next year, the year after. So as we go into FY23, FY24, but on a normalized basis, those are the numbers that I would think that these retailers generate.
Thanks, Saad. We've got the call recorded, so we'll come back to that in a year or two and see how close we get to that. Saad, you mentioned that we chatted earlier, and you mentioned a few other themes that are quite interesting. Just the credit versus cash component of sales. How do you think that develops? And again, who's well placed to take advantage of those trends?
Yeah. So if I just take you back a bit to last year, credit was obviously a lot of the retailers, Truworths, Foschini, even Mr. Price, Woolies, they all tightened up their taps. They didn't invest in their credit books, because remember that requires a lot more capital to invest in your credit books and lend out. So they tightened up the taps, and you saw sort of credit sales fall and cash sales rise. And obviously there's the risk of bad debts as well. So that tighter taps are probably going to continue until June, July, until we see some sort of recovery in the credit consumer. And I think from the second half of this year going into next year, you'll probably see that these retailers start opening up the taps on their credit books. I would think that Truworths, Foschini are probably the best placed retailers from a credit perspective to grow in that space. Obviously, Truworths has a history of managing their book really well, and those two names are probably for me the ones that will start opening the taps first. Thanks.
Okay, so credit probably hasn't done as well and should tick up from June, July. And then, Saad, just on the interest rates, I mean, we're obviously at all-time lows now. Has that filtered through to better spending?
Not, I would think that not entirely. I think lower interest rates have probably helped just put that extra few rands into people's pockets. I think most consumers are just more defensive and holding on to whatever they could have. I think the guys in the ultra wealthy or higher LSMs have obviously used this opportunity to buy hard assets, so properties and those type of things, to actually take it and invest in the stock market to take advantage of the low interest rates. But I don't think you've seen a lot of consumption spending taking place, maybe here and there, but it's definitely not reflecting into the numbers as yet. And I think people are just holding on tight unless you've got extra money to invest in hard assets.
Yeah, fair enough. I've probably got one or two more questions on apparel side before we move on to the food space, but just to remind the audience, guys, if you have any questions, please feel free to pop them into the chat. We'll try as best as possible to answer them. But yeah, we encourage any questions to come through. Saad, I mean, you and Ridwan often have the conversation about the property owners and the companies renting. How's the rental environment? You spoke about rental negotiations going pretty well for the retailers.
Yeah, so negotiations have been pretty well. I think you've seen a lot of the names, big names, getting reversions of around 5 to 15% on average. And then on escalations, negotiating them down to sort of, between 4 and 6%. So they are benefiting quite a bit. I think the guys with the biggest, who've been most aggressive, I'd say, are Foschini. The most amenable have been Mr. Price and Pepco, who are working with landlords. It's also, you don't want to be too aggressive with the landlords because, if things turn a bit, the landlords can be very difficult with you and when things change. So, and also the other third thing is that shorter lease terms as well. So, 5-year leases now moving down to 2 or 3 years. And then fourthly would probably be, cutting space. A lot of retailers are reducing space as well. Woolies have noted 10 to 20% space reduction in their stores. And a lot of retailers are moving on the food side and the clothing side, more smaller stores, more closer to the customers, and more malls, neighborhood malls, bigger malls, convenience malls, and that type of thing. Thanks.
Okay. Thanks very much, Saad. I think we're halfway through here, so let's shift across to the food retail space. And I mean, it's almost two completely different sectors. They're both retail, but they behave very differently. Just high-level thoughts on how the food retail space has performed and some of your expectations going forward.
Yeah, thanks, Avi. So in the food space, there's very strong diverging trends happening there. There's two segments of your consumer: the ones who've got money and the other ones who don't. So the ones who've got money and who have shifted from eating out in restaurants to eating in, and those retailers have actually benefited quite substantially over the last sort of 12 months. Checkers and Woolworths, and to some extent Pick n Pay and a little bit of Spar, they've done really well. It's all coming through in their numbers, very, very high single digits into double digits as well. So it's all about that shift in spending, and those guys have really outperformed. If you look at the contrary, you've seen Checkers, ShopRite, Usave, Boxer, and a few of the other sort of independents really sort of show sort of mid-single digit growth. So it's not bad. It's just not as fast as their peers. So I think this trend, as people still stay at home for longer, buy more groceries, probably likely to continue. And as a result, you've seen very strong sales coming through. Their costs have remained the same. Earnings grow, better cash flows, and ability to pay down debt faster than expected. And we've seen that with ShopRite in their results this week. Now they paid down 4 to 6 billion rands of debt just from the extra sales coming through. So I think the sector as a whole is premised on that. We've also seen very strong sort of investment into private label. That's growing very strongly as well. A year ago, we wrote the note that we said that private label was going to become a big thing. It has coming through, and we've seen sort of about 2 to 3 percentage points increase in most retailers' private label participation over the last 12 months, with a lot of investment going into that. Fresh is the other one as well, and then the other, something noted by ShopRite as well is the move also to smaller format stores, more neighborhood stores, and getting closer to their customer, especially in the Checkers FreshX format, and that is likely to be rolled out soon. So there's a lot happening in the space, and let's not forget e-commerce as well. I would say that the ShopRite's business, their Checker 6060 is probably the best platform in the market, and they're doing exceptionally well in that space and getting a lot of foot traffic. So yeah, I think that's sets the scene for the food retail space.
So I'm just going to pull through one of the questions. I mean, you have touched on it already, but the question is, are larger shopping malls dying with shopping no longer being a pastime where you spend the afternoon shopping, eating, getting entertained, and the desire for bling reducing? And I suppose that ties into your comments around the strategy of a lot of these companies, where they're going more towards the neighborhood type of model instead of the big shopping malls.
Yeah, so thanks, Avi. For relating to that, I think your big shopping malls, I just mentioned a few: Sandton, City, Waterfront, Gateway. A lot of that is also dependent on tourism. So we haven't had much tourism coming in, and they've come with spending power. So I would think that's why there's that trend. Once we get tourism coming back, once the borders are open, once globally people are traveling, I think you'd probably see those start ticking up again. But I think the normal SA consumer is not really going to, unless there's something that they really need in that mall, there's no need to go there. So most things that people are shopping are groceries and pharmaceuticals, and now and again clothes, and that all is done at their closest mall. So the bigger malls, I would say, were busy during Christmas season, where you're buying a lot of different types of items. So November and Black Friday, November, December. But other than that, I don't see the big malls sort of recovering anytime soon. Thanks.
Thanks, Al. Yeah, very clear. I'm gonna shift into some of the questions, and I think this is tied to your last note, where you talked about food inflation increasing probably above where CPI is going to be, and that was the question from the audience. What is your view in relation to inflation, and perhaps then go on to what this means for the retailers and who benefits from it?
Yeah, so if you look at inflation, one thing that ShopRite also noted is that Stats SA uses, I think, about a basket size of 240 items. Most retailers use 50,000 items. So there is a very big difference between your Stats SA inflation number versus food retailers. Food retailers generally, pass through a little bit lower inflation. They negotiate very hard with their food producers, and on the rebates, they're getting a lot of rebates from volumes, uptick in volumes. So, the inflation has been around, I would say, 3.5 to 4.5% on the whole. Spot touched 5%, but going forward into this year, I think this year will probably average between 4 and 5%, and Nedbank forecasting around 5%. I think the food retailers will be a little bit lower than that. And who would benefit? I think again, the ability to pass this on to higher income customers would definitely benefit those type of retailers. Checkers again, Woolies, Food, maybe a bit of Pick and Pay. At the end of the day, those customers can absorb these increases. Unfortunately, I don't think the lower end customer, shopping at USave, in Boxer, maybe ShopRite, will be able to absorb that increases, and you probably see volume declines coming through, or margin contraction. So I think it's all I think at this point in time, from a food perspective, it's all about who can absorb the increase and who's spending more, and that is obviously your higher income customer.
Yeah, this is an extremely interesting trend, so I'm going to put you on the spot. I'm not sure if you've seen any data on it before, but what is the percentage of spending in food retail that comes from the higher end consumer, and perhaps how elastic is that demand? You seem to suggest that these price increases will be absorbed by the consumer.
Yeah, I would think that. So if you look at all the retailers put together, the whole market is probably about 400 billion or so, sort of 300-400 billion. I would think that majority, half to I would think about 50% would roughly be coming from your higher income, and I think that shift has changed a lot. So an example would be ShopRite and Checkers. Checkers was about 30 to 35% of ShopRite's RSA business from a sales perspective, but now it's 40%, and they hope to get it up to 50%. So that dynamic is changing very quickly. So I would have thought maybe a few years ago it wasn't at these levels. So I would think that going forward, it probably can easily surpass 50% as a total market perspective.
And I suppose that's probably where the consumer wallet comes into play, that a lot of the upper end consumers actually shifting their spend away from the restaurants, whether it's because a lack of funds or whether it's because of the coronavirus. But that spending is probably being done at home, and that obviously impacts Checkers and Woolies. And then just on that point, Saad, I mean, Checkers is a clear plan to sort of attack Woolies customer. How has that developed?
Yeah, that is definitely a point that they have made, the Checkers and ShopRite. I think it's still maybe too early to tell. They've only got around 40 to 50 stores in the FreshX concept, and a lot of their growth is from space growth. So it's new space that's being added. On a like-for-like basis, we still think that it's very similar to Woolies. I wouldn't think that they've taken an exorbitant amount of market share. I remember the Woolies customer, the Woolworths food business has been built over 20, 30 years. And there's a lot of investment gone into their private label, their niche products, gourmet products, they're fresh. And that's the DNA of their business. And that's very, very, very difficult to replicate in anybody else. So, and a Woolies customer would go to Woolies for that. They're not going to go to Checkers for that. So I think Woolies, yes, their pricing points were a bit high, and that's something, they announced sort of 500 million to 1 billion rands of price investment over the next few years. And that's something that, they will become more competitive now. So they try and restrict people moving across, and they've also got a lot of the normal sort of basics. And we've done surveys that on basics, on promotion, Woolies is actually very competitive and sometimes 5% cheaper than their peers on the basic items when on promotion. So they're definitely becoming more price competitive. So I don't think you're going to see lots of market share losses to Checkers. But everybody has grown over the last 12 months because a lot of money has just shifted from eating out to eating in.
Yeah, and Woolies does also cut your mangoes for you, which is a massive win for them. But Sarah, I'm gonna join up two questions here. I think both of them touch on the online or the shift to online. Obviously, we're quite positive that off a low base, growth rates are going to be relatively high. I think the questions from the audience are around the sustainability of online shopping. So, will the shift to online retail be sustained post-COVID? And, I'll join another question here. Given the logistics delivery structural challenges in the non-urban parts of South Africa, do you see the investment towards online growth as a short-term strategy by the retailers to survive, or is this a long-term sustainable strategy?
Yeah, I think so. So the question we all have to ask is, how long does it take to get into a new habit? And I think 12 months is a long time for people to change to get into a new habit, and I think most people have got into a new habit of buying online. And so that habit and spending habit is probably likely to going to continue for forever. I think, despite vaccines, we are at level 1 now. Vaccines are being rolled out. I think people are still going. I think people are still shopping online. Yes, the growth rate will slow as your base increases, but I still think that you're going to see that big shift happening. I think the retailers are also on that same footing, and they're investing in that space as well. On the more sort of the rural side or less urban side, what's happening there? I think the click and collect model there will probably be one model the retailers will invest in a lot more, because obviously logistics challenges, security as well, credit card availability, those type of things is a challenge to gain customers. I think that most people have a phone or two, and just buying on your phone, and there's a lot of new digital apps that are available where you can pay through different methods. I think that you can just order it at your store and go collect it from your closest store. I think that's why retailers are actually trying to open up more smaller stores closer to your customer, where it makes that easier to go and pick up your items.
Yeah, that's a good point about tying it into the strategy that they're following. So, and I guess just to take it a step further, I mean, if we assume that online retail is going to be around and probably continue to grow over the medium term, what does this mean for the profitability of each of the companies?
Yeah, so if you have to split it out into the clothing and food, so from a clothing perspective, it is margin dilutive. The biggest cost there is obviously warehousing and logistics and returns. So that's why click and collect model will probably be most optimal from a profitability perspective, because you don't have that last mile delivery, and that's the most difficult and most most expensive. So if they find ways to optimize that, I think partnering with another retail, an online business, or logistics business to do that, I think that's so it is margin dilutive for the clothing guys. On the food side, very interesting that this is from Checkers, is that their cost structure is very low to run the Checkers 60/60 app, because it's from the closest store. The costs are the picker, the delivery fee for the driver, and then some amortization on the software. So to get the stock to you, and the margin is being made, the GP margin is being made for that store, and that store runs the delivery service for that area. So there's not much costs related to that business, and margins generally are sort of pretty similar to the rest of the business. But I don't think Checker 60 is a sort of different type of model, but I wouldn't say for all e-commerce businesses it's going to be similar margins, because if you start moving into distribution centers and warehouses and those type of things, then your costs just increase quite exponentially. So I think Checkers 60/60 are probably doing it the most efficient and profitable way.
Yeah, certainly the product offering from Checker 60 is fantastic. And so maybe just to build on that, I mean, is it going to be a situation where each retailer has their own online offering, or is there a space for an aggregated sort of logistics and delivery type of company? I know you hosted OneCart recently. Maybe your thoughts around that?
Yes, I think for the consumer who shops at different shops, definitely an aggregator is something that consumers will enjoy, especially on the OneCart platform. I mean, you've got Discount, Clicks, Macro, and a few of the food retailers, and definitely an advantage to be on that platform. From a cost perspective, for a retailer, if you're going to build it out yourself, it's going to be expensive. So having one of these guys run it, there's Zulzi, there's OneCart, you've got the biggest market share in the space, definitely advantageous. I think the challenges would be the product offering, how many numbers of items that you got on the platform, and pricing at the end of the day. Consumers, it's very easy for them to just open up the next web page onto the Woolies where they can get it 5 or 10% cheaper instead of going on OneCart. So I think those are the challenges that they've got to work around. But they've reached certain months last year they were growing at 500%, and now they're averaging about 100% growth. So they're still growing very strongly, and definitely something that's will be beneficial for the consumer. But yeah, as I said, pricing would probably be the key differentiator.
So maybe just to close the loop on the online theme, how does South Africa compare to global peers in terms of our market?
Yeah, online in South Africa, obviously it's been in a very infancy stage. As I said, we're on 1%, moved to around 5%, 6% as a whole. Globally, in Europe and the UK, it's on the clothing side. It's gone from 15 to 20% to like 50%. So it's grown exponentially. We're still well behind global peers, but I don't doubt that we can easily get to double digits over the next few years, especially with the investment that's happening by retailers in the space. I just think that over the last sort of 10 years, South African retailers just never thought it was important to invest in e-commerce because they were growing so well in brick and mortar. But I think I don't think we're going to get to 50% with global peers right now. I would think it's easily low teens. It's a comfortable range where we can.
Thanks very much, Saad. We've probably got 5 minutes left, so I've got a couple questions from the audience for you. So this question, I think hopefully they've been reading our FX research, and they're sort of asking about a depreciation of the rand. So if the rand gets weaker, will retailers be able to push these this depreciation or this increase in import prices into their prices, or would it have to be absorbed by the consumer?
Yeah, so exchange rate is a big driver of imports. So a lot of these retailers have been dealing with exchange rates for 20, 30, 40 years. So they know how to navigate through it. A lot of them take out hedging. If you look at the inflation versus over the last sort of 12 months, the inflation reported by the retailers versus the weakness in the currency. Currency depreciated like 18 to 20%, whereas you're not seeing that inflation number coming through from the retailers. So they're very, very good in terms of, the inflation is around 0 to 5%. So they're very, very good at managing that and taking out hedging, sourcing. So unless there's something major, I don't think it's going to be a big driver of your inflation right now. And I think that they can pass it on. A lot of them, absorb it a little bit, and they find ways to reduce their sourcing costs, so they don't have to pass it on. Because at this point in time, it's very difficult to pass on big increases.
And I suppose last question, Saad, from the audience here, just your views on private labels.
Yeah. So as I said earlier, private label is definitely a growth area for a lot of the retailers, and we've seen growth, between 10 and sort of 20% over the last few years, and that growth is actually continuing. We've seen also growth in the dealer-owned brands as well. So dealer-owned brands is a brand that companies start themselves. So think of Simple Truth by Shoprite. And it's something that's been, it's not really private label. It's not a Checkers brand, a Shoprite brand. It's their own brand that they created. So there's private label, there's dealer-owned brands that have really grown. Most South African average was around, so 20 to 25% private label. You can easily see that growing up to the high 20s. Woolies is at 88%. Spar, Pick n Pay around 24, 25%. Very strong growth. The packaging, the presentation, the quality, and the way retailers are marketing it is also grown very quickly, and also it's obviously cheaper and higher margin, so it's a win-win for everybody.
Awesome. Saad, thank you so much for your time. Always great listening to your views. You can hear the passion in your voice for the retail sector. I think I'm going to leave it to you, Saad. What's the 1 minute elevator pitch here? Just high level conclusion on your thoughts.
Yeah, I think stronger get stronger at this point in time. The retailers have got good balance sheets, low cost structures, and cash on hand will probably grow faster. They can invest in different assets and value creating strategies. And at the end of the day, I think we do think the listed guys will start outperforming unlisted players, and they continue their growth. We also think, from an investor perspective, multiples could re-rate as well. We think that better balance sheets, better market share gaining abilities for some of the retailers, for Mr Price, Pepkor, and TFG, would probably be investors could ascribe slightly higher multiples for them. So stay invested, and hopefully you'll see some good returns from your investments over the next 2 to 3 years.
Thanks so much, Saad, and thanks to the audience for dialing in. Hopefully, he's left you with a few pillars that can help your personal wealth. As Saad mentioned early on the call, it's split between those that have money and those that don't. So hopefully, Saad's enabled you to make some money. And there will be a recording available for those that weren't able to dial in. Please have a tune into that, and also please feel free to pop any questions through to Saad if you need any clarity on anything. Thanks very much, everyone. Have a good afternoon. Cheers for now.